So if I could just briefly introduce Ben Phillips from the University of Queensland's commercialisation arm, Uniquest. He's got carriage of a venture fund. We have Chris Leserve, Head of Investment at Queensland Treasury. There is some venture investment available through the Queensland Treasury and QIC. And Hasantha Uswatta from NAIF, who very nicely has agreed to come up from Sydney. We always appreciate people coming to Brisbane from Sydney. If you could join us on the panel. Now, the format for today is really very informalized. I ask Ben to perhaps give a quick overview of what he does and what he sees as the potential for investment in battery sector. And the same will apply to Chris and the same to Uswatta, or Hasantha, sorry. And then we'll have questions. So there's plenty of opportunity for you to ask the questions that I know a few of you will be quite interested in asking. So Ben, over to you.
Great, thank you. Thanks Lynette, and welcome everyone to our panel session. I wasn't really going to speak about the extension fund, but Deb kind of dropped me in it and suggested that I would be. So I look after the extension fund, which is an investment fund. It's $32 million established from retained earnings from Uniquest. We made the first investment out of that fund in November last year, so it's quite a new fund. And it's designed to invest in companies which are founded by students or alumni, or they're founded on research which is conducted here at UQ by staff. It's an evergreen fund. It's on balance sheet, so we have the advantage of not having to worry about limited partners as many other funds need to deal with. It's designed to take the risk early in some of these emerging opportunities. And I suppose the other beauty of the fund is that it lessens the dilution effect that subsequent rounds of investment into some of our startups have experienced in the past, because traditionally Uniquest, like most technology transfer offices, has only ever received shareholdings in these startups because of the license of foundation IP across to some of these companies. We have an independent investment advisory committee, and I suppose that the point for today is that we're pretty keen to align some of our investments to the broader investment strategy for the state in terms of battery chain related investments. So I think what we might do is just hand over to other members of the panel and ask them to maybe just provide 5 minutes about their view into investing into the battery chain. Yeah, you might want to hand it on.
I think everyone's got one.
Yeah, hi, I'm Hasantha Uswatta. I represent the Northern Australian Infrastructure Facility. So I'm not sure how many of you are familiar with the NAIF, so I'll give a sort of quick intro on what we do and then get into the battery supply chain and the work we do. So NAIF, or the Northern Australian Infrastructure Facility, was created in 2016 as a corporate Commonwealth entity to facilitate economic growth in Northern Australia. We initially had a balance sheet of $5 billion, which was increased to $7 billion in 2023. To date, we've made financing commitments worth about $4 billion. We have 5 mandatory criteria. The first being that it needs to be an infrastructure investment. Second, that it needs to be in our geographic region, which is the north. Third, the money needs to be repayable, so it's not grant funding. Fourth, there needs to be public benefit outside of the proponent. And the fifth, there needs to be an Indigenous engagement strategy. Our main product is debt. We have the ability to offer concessional financing, and we usually take a sort of cornerstone position in a financing stack to be for other commercial financiers to crowd into that the deal. We also do have an equity capability, but it's not operational yet. So in terms of the battery supply chain, I think we are one of 4 government financiers who have an appetite for this sector, the others being Export Finance Australia, Clean Energy Finance Corporation, and the newly created National Reconstruction Fund. With the $7 billion increase in our balance sheet this year, we've now got a sort of earmarked facility of $500 million to be allocated towards critical minerals, but we are looking at a pipeline which is much bigger than that. So the minimum allocation towards critical and battery minerals is likely to be 500, but it's like, in actuality, it's likely to be far higher. We play along the value chain of battery minerals. So the majority of the proponents we are working with, I think, right now are in mining, refining, or active materials. But we have had approaches from cell manufacturers, battery pack manufacturers as well here in Australia, but those discussions are still at relatively early stages. Outside of actual battery materials, we are also looking at other components of electric vehicles as well, such as rare earths. And of late, we've started looking seriously at flow batteries that Jeff spoke about. So the vanadium sector is also something we're doing some due diligence on currently. We also finance sort of enabling infrastructure for these projects. So quite a few of them require renewable energy generation capability as well. So that's an area we're looking at as well. Our process is run through an independent board, so all investment decisions are approved by our board. We have 2 gates: a strategic assessment phase and an ultimate investment decision. The investment decision stage is not dissimilar to a banking process. It's just that we have a higher risk appetite towards deals that the commercial sector may not have an appetite for. We work very closely with the Critical Minerals Office, so if there are any sort of new proponents who are looking to get funded in this sector, you can either approach us directly or through the Critical Minerals Office.
I might stand up actually, if it's okay, because I stuffed my back up at the weekend sort of doing some mulching in the garden with the kids, so if I'm wincing, it's because I'm 48 years old and getting a little sort of sore, so apologies about that. Chris Lasserve, Head of Investment, Queensland Treasury. I've just got a couple of really quick slides I wanted to really sort of convey to you today to just sort of show how we think about things. And when I sort of talk about we, I'm not talking about Queensland Treasury per se, I'm talking about a range of sort of Queensland government sort of agencies. So Accenture was commissioned a short while ago to sort of really sort of unpick the value chain here in Queensland and sort of look at the various sort of opportunities that exist across that sort of value chain. It's up on the Department of State Development sort of website. For those of you who sort of want to understand how we think, who want to sort of understand, you know, how we think about that sort of value chain, where we might sort of see different opportunities coming together, I'd very much sort of encourage you to go and have a look at Department of State Development sort of website. You can download the report there. But effectively, and I think it goes to some of the conversations that have been playing out a little bit earlier today, where we're very much in that space of trying to make sure that we capture the manufacturing opportunities here, we capture the processing sort of opportunities here, rather than necessarily sort of seeing those opportunities sort of exit overseas. In terms of the purple that's highlighted up there, that sort of really maps out across that sort of value chain where sort of Accenture feels Queensland's got some competitive advantages, and I think for those people sort of sitting in the room, probably certainly in the middle sort of three areas, you can see that they're sort of shaded a good colour of purple. So when Accenture's got out there, done its research, effectively they've come back to government, come back to a range of agencies to say that, look, they feel that there's a lot of strengths there from a Queensland perspective. So I think it's incumbent upon all of us to identify those opportunities and work through how we might be able to capitalise upon them in the state. What I did want to do is also just sort of show you how we've then sort of mapped out, well, here's the value chain that sort of exists. What is the government doing to support and really sort of accelerate those sort of opportunities? So to be honest, if I was to list every support program available that the Queensland government's put in place, this would be an incredibly crowded slide. So this isn't the totality of everything that exists, but it's a few that I've sort of picked to really sort of highlight the breadth of support that's available. The significant investment facilitation framework, look, that's for the very sort of big end of town where projects are talking about making very sort of material commitments to the state and very material sort of investments into the state, and therefore sort of get an enhanced degree of coordination. There's a $520 million invested in Queensland sort of program that effectively sort of spans the entire sort of value chain there. That tends to sort of deal with those projects that are either really substantial in scale, or where we might be competing against other states, you know, or maybe sort of other international sort of jurisdictions. The Treasury announced the opening of the $100 million Critical Minerals and Battery Tech Fund at the Critical Minerals Forum a couple of months ago. I guess, you know, we've been incredibly pleased with the response and the interest in relation to that fund. Treasury and QIC are sort of working on the distribution of that fund. It offers both sort of equity and debt, equity and grants to players sort of across that value chain. But I think, if anything, it's been a really good substantiation of the appetite and the interest and the opportunities that exist here in Queensland. QIC has also got a $100 million business investment fund. Now, that's not specific to battery tech sort of opportunities. That's sort of across a range of different sort of industry sectors. The one that I did want to touch upon a little bit, and it goes a little bit to what you were talking about, Jeff, in terms of you know, Queensland, how it's really sort of starting to accelerate in that VC space. So, you know, a year or two ago, we were thinking about, well, look, how could we really mature the VC sort of ecosystem here in Queensland? How can we sort of crowd in more investment? And on the one hand, you can go out and do something like the Business Investment Fund, where effectively you give money and it invests directly into the underlying organisations. But on the other hand, you could do something like the Venture Capital Development Fund. And what that's designed to do is partner with other VC firms effectively to leverage the state's money and then have that sort of deployed into sort of the underlying sort of organisations. And just to sort of give you a feel for the demand, for the activity, and I think the Premier was on record, so hopefully I'm not sort of divulging anything that I shouldn't. But, you know, that fund was substantially oversubscribed. When we were designing it and thinking about it and getting the approvals, we weren't sure how it might be received in the market, but over 650 million was effectively sort of bid back by VC firms. And I think that just gives you a view as to these are organisations that are seeing investment opportunities here in Queensland that want to partner up with government, not exclusively within the battery sort of space, but it's definitely one of the thematics that sort of came through very strongly in relation to that fund. State Development's also got a leading industry partnership program that's very much sort of also focused on activating supply chains. And then the other thing that, again, was sort of touched upon by Minister Butcher earlier is the Queensland Resources Common User Facility. That's a $75 million facility that's been developed up by Treasury at the moment, where effectively we will see a processing facility being constructed out of Townsville. Effectively what that does is, for those early stage sort of mining companies, they won't need to send their products overseas. They will be able to sort of get them processed to allow them to produce customer samples here in Queensland. We're obviously focusing on vanadium as a start, and effectively what we're trying to do, or what the government's trying to do, is take that capital burden away from them by providing that sort of common user facility, so that might then sort of accelerate those development sort of timeframes. I think if I was to sort of stand here maybe a couple of years ago, 2-3 years ago, this would be less of a focused slide, should we say, on the battery space, certainly in relation to this value chain. And yet in 2-3 years, you've seen hundreds of millions of more dollars being put and allocated towards this industry sector. So my sort of view is there's really substantial momentum behind this sector. The government's very committed to seeing organisations emerge, regardless of where you sit on that value chain. And my sort of personal view is I would expect that momentum to continue to build as we sort of move forward, noting that this is a very long-term transition that we're all sort of embarking upon. So that was it for me. Thank you.
Thanks, Chris. So, you don't often have in the same room the state perspective, an infrastructure perspective and a private capital perspective. So it's a great opportunity to ask questions of our panel. I assume the acoustics will be good enough if you just yell from the back.
Some microphone managers. Do we have some? Yeah, thank you.
Maybe if you've got a question, put your hand up and we'll get a microphone to you.
Oh, I think they got a bit bored waiting for all the work I promised them this morning. Yeah.
Okay, right up the back. And then Craig at the front.
Hello, Dave West from BatNav. The investment is very exciting around manufacturing in Australia, and as a former materials manufacturing engineer, that's quite nice to see. One thing that Jeff particularly spoke about was the competitiveness of the Asian manufacturers. And we want to scale up here in Australia, but those Asian manufacturers are going to continue to be more competitive, and they're also co-located with their customers, which is primarily the automotive industry. In the US, there's a large industry of small and medium-sized businesses that specialise in niche and specialised batteries for space, defence and other applications. We have very good human resources in Australia, very good education, highly skilled people that are suited for those types of businesses. What sort of approach is being taken in investment or looking at those industries where Australia could be competitive in the long term?
Look, it's a good question. I think the one thing I would sort of point to is, there's a partnership at the moment underway between the federal government and the Queensland government in relation to the $100 million election commitment that was made to establish a battery sort of industrialisation centre here in Queensland. That's got some sort of way to go in terms of its sort of development, but obviously sort of by co-locating, by building that sort of cluster effect, that's when effectively you'll get that sort of multiplier playing out across those slightly sort of smaller organisations. So that's sort of an initiative that's underway. I think sort of, as I sort of articulated, there's a range of other sort of programs that we start to sort of see individual organisations looking to partner with other organisations, so sort of coming together in some regards as a consortium or a consortia. So those are approaches that we're also sort of seeing in that sort of space.
Hello? Okay. Mine's a little more generic than just looking solely at the batteries. But where our advantage lies is getting that head start in the technology to begin with and being able to build a manufacturing footprint here. I think ultimately, if you are going to look to globally scale, you will eventually set up manufacturing offshore. And transport costs will just sort of dictate that to you eventually. But so what I've seen, if I look at tritium as the example, you still have a very strong manufacturing base here in Australia, even though they're now set up in the US and in Europe to manufacture as well. But the other thing that's remained here then is the research and development, looking at the future new products, the future development. And so what you're seeing here is the smarter jobs. that are going to remain in Australia. And the other thing that I think doesn't get recognised at all, what you're actually seeing is the brain drain from overseas. The people from overseas who want to come here and work in these smarter sectors are then coming to Australia. So it's not solely about manufacturing, I think, in that regard, but if you get it started here, it will stay here.
I was just going to ask a very simple question. How have you seen the global risk-off finance route wherein affect all of your jobs?
Finance markets overreact. That's pretty simple. I think there's definitely been an inability for what used to be easy, I think, for companies to obtain funding. What you've seen, probably the one that retreated the most, is if we go and look in the US market, where you had startups that were actually profitable that then couldn't raise funds, not ones that were making losses. And as a consequence, there's certainly been, job layoff that's occurred with that. It's natural in any business cycle that, they go through ups and downs in markets, and ultimately, but, the business must survive if it's going to go forward. So you must, cut your cloth accordingly, but by surviving, you are able to come back on the upside and re-employ again. I think Australia's been a little fortunate. We haven't quite had that same degree of exposure. So I don't think you've seen the same level of job loss here. If anything, we've always suffered from enough talent to go into them. And I think that's still our issue. We need to be bringing more people in. So I don't think we've suffered as bad here.
I think from our perspective, what we are seeing is a lot of these battery material projects, I think, are pretty large in terms of capex spend, and our upfront capex requirement is very high. While there has been a tightening in sort of global financial markets and more difficulty in raising the amount of debt and equity commitments that are required to make these projects go forward, there's also been a recognition, I think, post the Ukraine crisis, that the supply chains need to be diversified, and that there is a concentration of those supply chains through China at the moment. And if there is another potential crisis, then most of the OECD countries will remain exposed. So as a result, we're seeing quite a bit of appetite from especially the OECD countries, their export financiers, their development financing banks, to actually take positions in these projects despite the difficulties. And we're also seeing probably, I think the earlier question involved the automobile manufacturers. They themselves also see the risk of concentration, so that they are keen to take equity stakes in these. I'm talking about relatively large scale projects, so that we are seeing an increased appetite for them to take equity stakes or to contribute financing for these deals.
Yeah, look, I think the only other thing I'd mention is that it's a very fluid environment. We saw the UK government make some pretty interesting announcements about electric vehicles just recently. Obviously on the policy space, we had the US come out with the Inflation Reduction Act not too long ago. So it's a very dynamic sort of environment that we're all sort of playing in, and we're effectively sort of seeking to compete in. The bit that I always sort of come back to is Queensland's got a whole bunch of really strong competitive advantages within certain niches. My personal view is there's no point us going toe to toe, particularly with the IRA on the really sort of big end of town. But having sort of said that, we've got some really strong competitive advantages where, and we should be looking to sort of maximise our sort of expertise and broaden out the depth in those sort of areas. But it is incredibly dynamic. It is a competition that we're sort of seeing playing out in front of us, every sort of new cycle at the moment.
Stephen Grocott, Queensland Pacific Metals, and Hasantha's partly answered this question, and it goes to the slide that you showed, Chris. I think there was that Accenture report. Before I read it, I thought, oh, here's another one of these reports that'll be a load of rubbish, but it's actually very good, and you picked out one of the key slides. The refining step, or the processing of the raw materials into the manufactured product, the chemical manufactured product, usually. As you said, Hasantha, that's a big chunk. You know, these things, you're typically starting $500 million to several $1 billion. If you look in the nickel cobalt industry in Indonesia, the typical ticket size there is several $1 billion. Ford, Vale, Huayu just announced $4.5 billion investment for a nickel cobalt production facility. The challenge in Australia, yes, debt can be difficult, but the challenge is the equity plug. And it is such a monumental challenge. And I look at it distresses me, not just as CEO of QPM, but take that hat off as an Australian, to see the likes of Pilbara Minerals and Lynas and Sara Resources building their plants in countries overseas because it's just financially more attractive for them. Construction costs, yes, there are lower, but the operating costs in Australia, as Jeff has alluded to, the skill set here and the productivity, the operating costs are not punitive in Australia at all. So any comments about securing the equity for that middle rank that you talked about, Chris?
Look, I think sort of an observation on my side is that, you know, it is incredibly tough, so I totally agree with that sort of position. I think manufacturing as well, you know, scaling up to deliver manufacturing outcomes, again, is incredibly tough. So I wouldn't sort of pretend to anyone that sort of that's an easy part of the journey. You might have something that is certainly sort of commercialised, certainly sort of proven at a certain sort of scale, but when you need to go and raise hundreds, or in your case, sort of billions of dollars, you know, and you've got to borrow or you've got to secure equity, that's a really challenging sort of thing to do, and we've seen sort of companies flounder along that sort of journey, you know, despite having excellent sort of products. You know, I think sort of, obviously the National Reconstruction Fund has got a strong sort of equity component to it. I guess sort of my reading of the tea leaves is the federal government is much more sort of interested in equity as a support mechanism rather than other mechanisms, so that might be sort of then used to help sort of capitalise and get some of these sort of larger projects off the ground. I think sort of my approach, my sort of thinking in this space is, even if we're a small part of a bigger sort of jigsaw puzzle, what can we do to crowd in that other investment? You know, I have a view that ultimately, if we want some of these projects to get off the ground, as it were, we've got to be in that sort of leading space. We've got to be able to sort of say, look, maybe we're not putting the biggest sort of dollars on the table, as it were, but to what extent can we crowd in that private sector investment? We'll look at it through a different lens than maybe sort of Jeff and others will, per se, but to what extent can we go out there and crowd in that private sector investment in the equity sort of space? But it's incredibly difficult.
Yeah, I think my comment on that also is, I mean, we fully recognize for even sort of listed junior miners having to raise multiple times their market cap as equity is extremely challenging. But we have also seen, though, that there is, I think as Jeff has alluded and Chris has spoken about, there is a sort of deepening of the capital pool that's available here, whether it be various government financiers or different levels of government who are willing to contribute grant funding, with the recognition that this is an industry that Australia needs to make strides in. I think there's increasingly more capital getting allocated to this sector. And I think that'll help in sort of increasing the awareness among equity investors as well, and potentially attracting more institutional equity into these type of projects too.
Okay, we'll have to probably give it one more question. So we've got one halfway on the right side there. Yep.
Yeah, thank you. Peter Hansford from Deakin University. I was going to ask about the impact of the Inflation Reduction Act on the investment environment generally. But I'm wondering if I take a different slant on that. The IRA, I think, has invested about 3% of the funds in hydrogen. Australia, on the other hand, is making a big play on hydrogen, and I'm wondering whether there is a hydrogen hype, and also whether we're investing in something that's going to take too long to actually deliver. So, interested in your thoughts.
Yeah, I think I did allude that technology, you know, there's definitely some challenges around hydrogen, but there is a lot of funds and research going into it. I think Japan, especially, is one of the countries that is doing an awful lot in, you know, looking at hydrogen, how especially taking the path of hydrogen for mobility is where they're tracking down. Cost is the key issue to it. You know, I think when we can get that technology breakthrough that we can generate hydrogen a lot cheaper and then work out how to store it effectively a lot cheaper, I think the actual distribution and use of it's not going to be the challenge that it is. Yeah, don't have a magic answer for you, but there's a lot of money and a lot of research going into it. So hopefully in a few years' time, we'll see a big step change in that area.
I think as an investor in this sector, obviously one of the challenges is that there's a lot of different technologies that are still sort of scaling up and coming to that commercialization stage. It's at this point in time, I mean, anybody's guess as to which of those technologies will ultimately win out. Our sense is that hydrogen will have a role, but there will obviously be certain technologies that are developed quicker and certain other ones which will take a while more for commercialization. It's just, I think, the challenge for projects or proponents in these kind of hydrogen or the more emerging space is obviously attracting financing while the technology race is on. So I understand that that's the difficulty here, but I think any investor who plays in this sector is currently looking at all of these different technologies and sees that a variety of them will be required to make this transition.
Yeah, look, I think from a Treasury perspective, we're working with, you know, a range of proponents in the hydrogen space. You know, they're typically sort of large-scale CapEx projects. You know, my view is that you have to take a very long-term view in relation to hydrogen. You know, there's a long way for these projects to go. But if you adopt that sort of mindset and perspective, I think sort of there's some good opportunities that are starting to emerge, but you do have to adopt a very long-term view. Obviously, the federal government's got the $2 billion Head Start program as well that's been put on the table to catalyse maybe 2 or 3 projects. You know, I think that'll be sort of signed up through the course of next year, but you do need to be taking a 10-year plus sort of view, is my view.
Okay, well, thanks panel very much for your time this morning. I'll get into trouble if I run too much further over time since we're already behind time.
He's already in trouble.
So that was a nice wrap from very early stage investment from first time out of the lab right through to large billion-dollar infrastructure spends. So thanks everyone for being involved and the audience for your questions.